Cryptocurrencies provide most flexible investment options. Investors can purchase a variety of financial derivatives in addition to actual Bitcoin, which gives them the opportunity to make money in a different way. Although Bitcoin ETFs may sound a little complicated, using them is actually quite simple. You'll have a ton of investment opportunities available to you once you comprehend how various types of ETFs operate. So let's start with what is an ETF. A type of investment fund known as an exchange-traded fund is traded on stock exchanges, much like stocks. These funds typically invest in a range of assets, including stocks, commodities, and digital currencies, with the goal of tracking the performance of this index. In order to replicate the performance of the index, an S&P 500 ETF, for instance, holds shares of the companies included in the S&P 500 index. To continue tracking the index's composition and performance, the ETF manager modifies the fund's holdings when it's needed. Okay, so what is a Bitcoin Spot ETF? An exchange-traded fund that holds Bitcoin directly as its underlying asset is known as a Bitcoin Spot ETF. This implies that a spot ETF's performance is directly correlated with the current value of the Bitcoins it owns. Despite not holding any Bitcoin personally, when investors purchase shares of a spot ETF, they are essentially purchasing a representation of real Bitcoin. But what are pros and cons of Bitcoin Spot ETF? Purchasing a Bitcoin Spot ETF has a number of benefits. First, it allows for exposure to fluctuations in the price of Bitcoin without requiring users to store the cryptocurrency. Additionally, by integrating Bitcoin into a regulatory framework and trading on traditional stock exchanges, it builds more public trust in it. Finally, when operating within the framework of stock trading, investing may be simpler for conventional investors. However, there could be risks just like with any investment. A Bitcoin Spot ETF's value will fluctuate along with the price of Bitcoin. Moreover, because of fees or other administrative issues, the ETF might not always perform exactly like Bitcoin's price. Despite the fact that ETFs bring Bitcoin closer to conventional finance, the overall cryptocurrency market is still unpredictable. Finally, due to additional fees levied by the ETF, trading is more expensive. Now let's quickly present what is a Bitcoin Futures ETF. An exchange-traded fund that doesn't hold actual Bitcoin is known as a Bitcoin Futures ETF. It makes investments in contracts to buy or sell Bitcoin at a predetermined price at a specific future date, known as Bitcoin Futures contracts. This enables investors to speculatively forecast Bitcoin's future price changes without actually owning the digital currency. So, now what are pros and cons of Bitcoin Futures ETF? Similar advantages apply to Bitcoin Futures ETF and Bitcoin Spot ETF. They give investors a way to track changes in the price of Bitcoin without having to control the actual cryptocurrency. They also work in a controlled setting, abiding by the rules established by financial regulatory organizations. Additionally, they offer greater liquidity compared to other investment products, making it simple for investors to buy or sell shares of the ETF. No direct exposure to Bitcoin is one of the risks of Futures ETF. The value of Bitcoin Futures ETF might not always move in lockstep with the price of Bitcoin, in addition to additional management costs, lowering returns. Finally, because the counterparty managing the futures, these ETFs are subject to counterparty risks. So, that's the end of the video around everything about Bitcoin Spot and Futures ETF. Now, if you have found the content helpful, don't forget to give this video a like and subscribe to our channel for more content like this. Thanks for watching and see you in the next video. Until then, goodbye.